Hi guys, I welcome you to another part of this masterclass. Sorry. In this part, we'll be looking at liquidity and inducements. What is liquidity? In short, liquidity simply means money. Liquidity means money in the market. So anywhere money resides in the market, either traders that are buying or that are selling, then liquidity is present there. So by saying this, from your thinking, from your perspective, what do you think liquidity is? The moment you place a trade, then liquidity is present at that point where you place your trade. So this is used against traders by the smart money concept and by the money makers, the big banks, they use it against traders by clearing their liquidity before making their move. So as a smart money trader, that is why you have to take note of where liquidity resides in the market for you to know how to make your move and trade just after the big banks so that the accuracy of your trade is going to increase. So for example, at every support and resistance in the market, liquidity resides here. While explaining to you guys about the retail traders, the retail concept, I explained to you for support and resistance, we have a zone like this. Then the price moves just like this, hit the resistance, then come back to the support, to the resistance, to the support. Something like this, you see all these points are liquidity. Liquidity is here because why? Traders are placing they are placing trade here. They are placing trade as they are placing trade here, they will have their stop loss at these points and probably looking to sell. And at this point also, liquidity is present. Why? Because traders do place their trade here and expect to buy to the next resistance. So all these points, these zones are all liquidity. So what are the money makers, what are they going to do? They might make a move like this just to clear the liquidity. So this move to clear the liquidity, or let me put it here, because they will like to accumulate enough of money for them to clear. Traders are here buying, traders are here buying, traders are here buying, and the money makers will just come like this to clear the liquidity and probably give you something like this. They will test back your zone and continue moving higher. So what did they do? They cleared this liquidity. The orders that are placed there are being cleared. And what do we call this? We call this stop hunts. So this is called stop hunts, and the abbreviation for it is SH. So for this as well, you can see something like this. Since this is liquidity, they can move like this to clear it before going to their direction. So this is called stop hunt as well, as this liquidity was taken. So all your support and resistance, all your trend line, even trend line like this, is a liquidity to the money makers, because traders are looking to buy or at the touch of the trend line, while the money makers will do what? They will clear the liquidity before going back into the zone and probably make something like this before moving up. So what happened here? The liquidity was grabbed here because there is a lot of money here at this trend line because a lot of buyers are here looking to buy here. They bought here, they bought here. So money is here and they have their stop loss below their order. So what's going to happen? Even some are looking to buy at this point, while the market will just come down, grab the liquidity and keep moving to their direction. Even I told you at any point traders are buying or selling, liquidity is there. Even at this point, there's liquidity. So why do you see break of structure? It's just to clear the liquidity at the high of the market. That's why you see break of structure. It's going to clear the liquidity, break this structure. It's clear the liquidity for those that are trying to go against the trend, that are trying to sell, even if it's short-term sell, then the market is just going to break the structure and grab the liquidity. So liquidity is everywhere in the market. And as a smart money trader, you have to watch liquidity. Liquidity is your fuel. You don't take trade when you don't see any grab of liquidity. So the best move in the market it occurs only when the liquidity is taken already. So the price moves around just to grab liquidity. After grabbing the sell side liquidity, it goes again to grab the buy side liquidity. So that is what moves the market. Liquidity moves the market. So all those pattern, retail pattern, the flag, everything are all instruments for liquidity. For a flag, you have something like this, right? You have something like this. So all these are instruments for liquidity. What's going to happen? The price will just come down to grab the liquidity before moving higher. So all the double top, they are all they are all instruments for liquidity. Because you have a double top like this, then what's going to happen? The price will come back like this, grab it before moving down. Go and back test your charts. You are going to see all this I'm explaining. So this is liquidity. Any equal low or equal high liquidity. The double bottom are all liquidity. Any equal low or equal high is liquidity. This is liquidity. So just have it in mind. Any equal lows or high is a liquidity. Trend line is a liquidity. Support and resistance are all liquidity. So let's go to the charts and spot some liquidity. Take a look at this. This is liquidity grab First touch, second touch, then what happened? The market came here just to grab this, and what happened? It continued moving downward. Take a look at this as well. Equal highs. Then what happened? This is an equal high. This small hunt is a liquidity grab. Then also trend line liquidity. You have something like this. Then what happened? First touch, second touch, third touch, the market comes down, grab the liquidity, then continue moving upward. I will try to get more examples to send to the group so that you guys can see very well what is meant to be liquidity. So let's go to the next topic, which is inducements. Inducements. Inducement is just like liquidity, but there is a little different. There's a little difference between inducement and liquidity. Liquidity means taking away money from the market, taking away money from traders, the money makers taking away money, while inducements mean faking traders to go into a trade early. Like they fake traders to take a buy early or take a sell early, while they come back to clear away their money. That is inducement. But liquidity, they go grabbing their money. Inducement, they fake traders to go into the market early. For example, you have your zone here. You are looking to sell. This is your order block. Your order block is here. It broke structure. This is a break of structure. And this is your order block. So what are you looking to do here? You are looking to buy, to sell rather. So the price will just form something like this. Without getting to your order block, traders who are not patient enough will do what? Or it forms something like this. Traders who are not patient enough will do what? They will enter for sell here even without touching their order block. They will enter for sell, and at this point inducement is present because traders they are tricked already. They are forced to take their order, and what is going to happen? The markets can come back again like this. At this point, it is turning to liquidity because it is forming equal highs, and at the same time, it is inducement. Why? Because we have the real order block, the point of interest where you are looking to sell is here. Now what's going to happen again? The price will still come back to retest the block and move down. You see, at this point we are having two liquidities. Liquidities is here and also liquidity is here. So money makers are going to come here to grab the liquidity and inducement at the same time because it is closer to the point of interest. So they fake traders to take their trade and come back to clear it before moving downward. So also for the buy is also the same thing. So this is inducement, simply faking traders to take early buy or early sell and while they come back to clear it before going. So liquidity and inducement are almost the same thing. Let's go into the charts. Probably I'm going to see one or two examples to show you guys. Yes, take a look at this. This is a point of interest here. Yes, remember I told you how to mark out an order block. This is a valid order block because there is a little imbalance. It wasn't retested yet. Yes, there's a little gap there. So this is valid. Why this is inducements? Why? Because early sellers are here to sell the market. They are here to sell it here, but the real move hasn't started yet, and it even came back to give a small retest again, and even another sellers are here to sell while the market reversed just to touch the order block before moving. So all these are termed as liquidity now and also inducement because this is equal highs, inducement and also liquidity. Can you see? If you look at this very well, the right order block is here. As I explained to you guys, for your order block to be valid, it must have imbalance and it must not be mitigated yet. As you can see, all these are already mitigated. So the next order block, you are going to move to the next candle to mark out your block. Then these are early buyers and they were induced because it hasn't touched the order block yet. Can you see? Before it came back to clear the liquidity and the inducement before moving higher. So it is everywhere. Looking at this, this is the other block. This is the other block. While this is the inducement. Early buyers. It came back to take their money before moving upward. So you can see them everywhere. You can see them everywhere. Okay, guys, this will be the end of the video. In our next class, I think we are going to move to the strategy. By now you should be I think I've covered enough of concept for you to understand how the concept works. In short, smart money traders use liquidity as their fuel. Liquidity is their fuel. Anywhere you see a liquidity grab, then a big move is about to happen, because that is the tricks of the big banks, the hedge fund, the investment company. After grabbing the liquidity just to take traders' money, then they start the big move. All right, guys. See you in the next video. Have a wonderful day. Bye.